The Australian government is about to launch a coordinated attack on superannuation, and it all kicks off on July 1st, 2026. Today, we are breaking down the 4 biggest changes coming to super in 2026. If you are not prepared, you could accidentally breach your contribution caps and get hit with a surprise tax bill. Most people assume they'll have plenty of time to adapt, but these changes are a perfect storm. They are designed to work together, and they will catch millions of unprepared Australians by surprise. I'm Troy, founder of Blue Chip SMSF, and we've set up thousands of SMSFs for Aussies. Today, I'm walking you through the 4 critical changes you need to know about right now. The Payday super trap, the new caps, the Division 296 tax, and the death of a popular loophole. Welcome to SMSF Insider, where we help busy professionals to gain financial independence using an SMSF. Hi, I'm Troy, founder of Blue Chip SMSF Services, and over the last 20 years, I've helped thousands of Aussies manage the complexities of self-managed super funds. And in this podcast, I'll answer your questions, break down the myths, so you can take charge of your financial freedom. Let's get into it. First up is the most insidious trap of them all: Payday Super. From July 1st, 2026, employers will be required to pay superannuation on the same day they pay your salary instead of quarterly. On the surface, this sounds great, but for anyone who salary sacrifices or makes regular personal contributions, this is a disaster waiting to happen. Here's the trap. The last quarterly super payment for the 2025 to 26 financial year is due on July 28th, 2026. This payment will land in your super account after July 1st, 2026. At the same time, your employer will start making fortnightly or monthly payments from July 2026. This means that in the 2026 to 27 financial year, you will have your normal 12 months of super contributions plus the final quarterly payment from the year before. You will have roughly 13 months of contributions in one financial year. For those who salary sacrifice, it will be important to sit down with their payroll department before June 2026 to adjust the sacrifice amount for the 2026 to 27 financial year to account for this overlap. And speaking of contribution caps, that brings us to the second major change. Change number 2 is that the superannuation contribution caps are increasing. The concessional, before tax, contribution cap is indexed to rise from $30,000 to $32,500 on July 1st, 2026. This is a rare piece of good news, but it also makes the Payday super trap even more confusing. It gives a little more headroom, but not enough to absorb the 13 months of contributions. Remember, any unused concessional cap amounts from the previous 5 years can also be used. This is going to be a critical strategy to manage the Payday super trap. Just quickly, guys, if you're a busy professional, fed up with traditional super funds and overwhelmed by the setup of your SMSF, we can help. Book in a call with my team using the link in the show notes, and let's build your future on your terms. Now, back to the episode. Now, the one that has every high net worth individual in the country scrambling, the government is introducing a new 3rd tier of tax on superannuation starting July 1st, 2026. This fundamentally breaks the promise of superannuation. For the first time, the government will be taxing the unrealised capital gains in your super fund. It's a wealth tax, plain and simple, and it's starting with super. If your total super balance is over $3 million at the end of a financial year, any earnings on the amount above $3 million will be taxed at an additional 15%, bringing the total tax rate to 30%. Crucially, Earnings includes unrealised capital gains. If your property or share portfolio goes up in value, you pay tax on that gain, even if you haven't sold the asset. For example, if you have a $4 million super balance and your assets grow by 10%, $400,000, the earnings on the $1 million above the cap, $100,000, will be taxed at 30%. That's a $30,000 tax bill, even if you haven't sold anything. If a super balance is approaching or over $3 million, many people seek specialist advice immediately. When the Division 296 tax was announced, the immediate strategy was obvious. If your balance is, say, $3.1 million on June 29th, just withdraw $101,000 to get your balance back under the cap before the end of the day. The government is one step ahead. They have written the law to specifically kill this strategy. They will calculate the tax based on your opening and closing balances, and they will add back any withdrawals you made during the year. The formula is complex, but the outcome is simple. You cannot avoid the tax by making a last-minute withdrawal. So there you have it. The four horsemen of the 2026 superannuation apocalypse: the payday super trap, the new caps, the Division 296 wealth tax, and the death of the withdrawal loophole. These are not separate issues. They are an interconnected web of changes that require a holistic strategy. It's important to be thinking about this now. The window to prepare is closing. Don't get caught out. Thanks for watching, and I'll see you in the next video.
Thanks for tuning in to this episode of SMSF Insider. If you got value from this, make sure you subscribe so you never miss the strategies we share to help you take control of your financial future. Find us on socials at BlueChipSMSF or